Rajeev Malik of CLSA has joined in with his thoughts. Rajeev, good morning. The consensus is that we'll get 25 basis points repo rate cut. But how strong is the case for a pause in this policy?
Well, the only pushback for a rate cut is the high CPI inflation. Now, bear in mind, back in January, when the RBI cut both the CRR and the repo rate, CPI inflation was high. I mean, not as high as it has been in February, but still, in terms of a pushback, it would have still been there. Now, the rather idiosyncratic approach the RBI follows with giving greater weight to WPI rather than CPI means that the decline in core inflation on the WPI will play a greater role in setting the interest rate as opposed to CPI, hence the case for a rate cut.
Rajeev, hi, morning. This governor, though, has a track record of saying, well, here's the rate cut, but guess what I actually think about the economy and how bad things are. Do you think it could be that kind of a note where the rate cut comes in so you can get your 25 bips, but he's not happy at all about the way things are shaping up?
Well, it's possible. I think less so this time around because RBI has rather been uncharacteristically positive in terms of what the budget has delivered so far. So I think at best in terms of its guidance, which is really what the most important part is going to be, he will indicate scope for more easing but make it a conditional statement in the sense that the government would have to continue delivering both on the fiscal and also move ahead with supply side issues, not to mention how the global backdrop shapes up. Don't forget, as it is, RBI has shifted its tack in terms of what the high current account deficit means for its interest rate policy. In January, it was indicating that the high current account deficits limits the scope of monetary easing. Recent speech by the governor seems to indicate that is less of a problem. So in some sense, the surprise element that you're perhaps referring to really makes RBI's policies a bit like Bollywood item numbers. The moves are there, but how it fits into the broader script, can be debated.
That must be the first time I heard the Reserve Bank governor or anything he does compared with Bollywood, Rajeev. That really is a first. But transmission has been the problem, Rajeev, for this market and for banks generally. I mean, how much transmission do you expect to see from anything the Reserve Bank does, and how much impact, frankly, in terms of loan growth?
Transmission doesn't necessarily need to take place the same day. If you look at the rather strange behavior that the month of March brings about in Indian money markets, especially in terms of all the banks busy window dressing their accounts for the fiscal year end, the fact that you also have an impact coming in from the quarterly advance tax outflow, and finally, the pretty large cash balance that the government is sitting on, all of them will limit the immediate transmission. But by the time we get into April, early April, I think a lot of these factors are going to reverse. And that is when I think banks really will begin to pass through some of these changes. For the reasons I mentioned, I think there's really no compelling case for a CRR cut. I know the finance minister has already indicated that RBI would pay attention to the liquidity concerns. He's even indicated there will be a paragraph in the policy statement. I wish he had given us the text as well. But I think, 800 billion of cash balance that the government has with the RBI and the initial impact of the advanced cash outflow, I think makes the underlying core liquidity shortfall in LAF not really all that worrying to prompt a CRR cut just yet. Not to mention in 2 weeks' time, the liquidity setting is going to improve in any case.
Growth aside, Rajeev, India's other big problem has been the domestic savings rate and the reluctance of most domestic savers to put anything in financial instruments because of negative real interest rates, which has been there for some time. Do you think if rates start going down, this is further discouraged and we don't have a problem, a way around this problem, something that the Reserve Bank might also be fretting about?
Then ultimately, I think the peculiarity of the problems that India has and how India is going about dealing with them is really as follows, that high inflation reflected in the CPI because households focus more on that. WPI, I don't know any household who will tell you that inflation in India is 5 to 7%. So as long as RBI's interest rate setting is focused on WPI and does not take or give enough importance to CPI, it can keep cutting its policy rates, but the transmission will be compromised. Equally, demand for alternative assets such as gold because of high inflation will still be strong. So actually RBI needs to take a closer look at the inflation yardstick it is using. I'm not sure very many people will buy the WPI if you were to think of the household's perspective. Businesses and government, of course, will try and push WPI because it is showing much lower inflation.
The other problem is how much of these rate cuts actually end up helping growth, because RBI, the logic for everybody clamoring for the rate cuts is that growth is slipping, and with rate cuts we'll rediscover growth. Does that really follow, or is the RBI know in heart of heart that it may oblige with small token cuts, but that's not going to fix the growth problem?
I think, lower rates are better than no rate cuts, but anyone expecting them to necessarily fix India's growth shortfall or problem, I think that's rather wishful thinking. Bear in mind, for the last several months, everyone was arguing about rate cut and how they would do magic as far as sentiment is concerned. But ultimately, it was really government waking up and beginning to do some right things that was really the critical turning point. And I think once again, the growth ball is very much in the government's court. RBI can play at the margin a constructive role, but don't forget there is no scope for 300-400 basis points of rate cuts in India. And another possibly 7,500 basis points is incrementally better, but not necessarily a game changer.
On that other point about policy, Rajeev, there is chatter again that maybe by the end of this budget session, at least we see something in terms of FDI and insurance. Are you happy with the kind of trend we've seen on policy? Because ever since oil and gas, there hasn't frankly been that much movement, and the budget, as we were discussing, was a disappointment.
Well, in a way, I'm not actually surprised. I think, the initial 6 months from the middle of last year was really where a lot of the action was. And as we progress through this year, you get closer to the election calendar, the ability to take tough decisions is going to become more compromised. It is somewhat interesting that, RBI policy is on the same day as the Cabinet Committee is going to discuss the food security bill, which has to be the single most important negative any government could deliver as far as the fiscal dynamics are concerned from a medium-term perspective.
Always a pleasure speaking with you, Rajeev. Thanks very much for joining in with your thoughts. That's the CLSA view on what may or may not come through from the policy in a short while from now. But yes.